Jeni Browne. Welcome to this week's MFB news. Hope everybody is keeping well and warm. Actually, it's sunny term, isn't it? In fact, we've gone in, the heating is now on. Last night I got in from work and in the house it was 14 degrees and I just thought, you know what, life's too short, the heating is going on. So I treated myself to a little heating boost. Now, in terms of what we've got for you this week, we're going to do our usual roundup in terms of what's been happening with swap rates and lender pricing changes. We're then going to move on to taking a look at pets in rental properties. We're going to look at some research, try and get a grip essentially on how the changes that are kind of coming with the Renters' Rights Bill, how many people it's going to actually impact, and then what you can do about it to protect yourselves as well. And then we're going to be having a look at what the very, very intelligent people in the city, the economists, are predicting for base rate going forwards. Swap rates first of all then. So basically, yet again, no real change. I mean, things do move around, right? So there is a slight change, but nothing that would be any sort of material interest. So where are we at the moment? So 2-year swaps just over 3.7, 1 month ago just under 3.7, and 1 year ago we were at 3.8. On your 5-year swaps, 3.77 was 1 month ago 3.76, and 1 year ago 3.5. So 2 years were kind of slightly up year on year, and 5 years were slightly down year on year in terms of positivity rather than actually the rates. So that's confusing, sorry. But look, nothing's really moving. I think actually one of the things that I'm reading a lot of articles on at the moment is how the rumour mill is obviously rife in terms of the autumn statement and the various kind of ways that Rachel Reeves could look to plug this big black hole that we all have heard about so much. And taxes are obviously kind of coming to play. And so there's a lot of kind of commentary around if Rachel Reeves does this particular thing, which apparently she's really seriously considering, the impact it would have on essentially the UK bond market mortgage rates in a kind of very trickle-down fashion. So I'm actually pleased that things haven't gone up massively in anticipation of the autumn statement. There is room for this to happen. Let's not be under any false illusion. But at the moment, hopefully the markets are just recognising that everything is purely hearsay at this stage. And so there will be no need to kind of knee-jerk right now, but we will absolutely keep you posted. Alrighty, now moving on to lender pricing changes. And again, because there hasn't been any real change in lenders' cost of funds, there hasn't been a huge amount of change in mortgage pricing either in the last week, but there have been a couple which are worth noting nonetheless. So first of all, we've seen Santander increase their rates by up to 0.1%. Santander as a lender, they are a very vanilla lender, sort of, you know, for a typical clearing bank who does a little bit of buy-to-let. They're not lending to limited companies, they're not lending on HMOs or multi-units, they don't like you to have more than 10 buy-to-let properties. What they are quite good at is property types, is what I would say. They seem to be kind of very open to properties which are of a slightly unusual construction. So they tend to take the kind of stance that if they would lend to it on their homeowner range, then they would lend to it on buy-to-lets as well. Some lenders don't do that. They have a different kind of risk profile for buy-to-lets versus homeowners. So that's one of the things that Santander could be quite good for. So if you're an individual with a small portfolio of property looking to refinance something that's made from, I don't know, some sort of unusual construction type, Santander could be a good home for you. Now, we've also seen Virgin conversely bring their rates down by 0.15%. Virgin, I'm going to lump them in with Santander, actually. The criteria is very, very similar. Excuse me. The things that I have always found Virgin to be most notable for is, first of all, day one remortgages against open market value. Those guys can do these. Another thing they seem to be very open to is deck access. Now, deck access is a term which lots of people don't actually aren't familiar with. So essentially, if you imagine a block of flats where you got a set of stairs inside the building, you pop out on a balcony and you walk along a balcony on the exterior of the building to get into the flat through the front door. That balcony is referred to as deck access. So a lot of lenders aren't crazy about these, but Virgin are a lender who can take a view on these for sure. Now, BM Solutions have increased their rates by 0.1%. So as you can see, there's a kind of real like tinkering here going on, up 0.1, down 0.1. BM Solutions, you guys will be so familiar with. We really enjoy dealing with them. Service is incredible. They're very kind of binary. Either they will lend or they won't lend. There's no messing around, no kind of room for discussion. But when they do lend, their pricing is incredibly competitive. They're very good in the limited company space. And we'll talk about that, I'm sure, another time. But yeah, these guys, again, they're a good lender if you've got a small portfolio. if you are looking to mortgage a fairly standard property. BM Solutions are an interesting one with property types actually. So their kind of position is a little bit more flexible, should we say, than a lot of other lenders. So they don't tend to have hard and fast rules. So what they wouldn't lend on is a licensed HMO with, say, 7 rooms. They certainly wouldn't lend on a block of flats. But in terms of location, being over commercial, ex-local authority, high rise, some of the things that people can kind of get stuck on, their position tends to be they just refer to value as common. So if the value goes out and says, yeah, do you know what, it is a flat, it is above a, fast food outlet on a busy high street location, but there is a really strong demand for these kinds of properties nonetheless, then actually BM Solutions could certainly lend, so they're very good for that. Now finally, we've seen fleet mortgages make reductions to their HMO and multi-unit freehold block range, but up to 0.15%. So I'm glad that the weighting is on rates coming down this week rather than up. Fleet are a specialist lender. They lend to limited companies and individuals. They're good at people with large portfolios. I'm currently doing a bunch of remortgages to Fleet for a client who's got over 100 properties in their portfolio, so very, very good on that. They can consider kind of smaller HMOs and multi-unit freehold blocks, so nothing big. So you wouldn't be going to them with a 10-bedroom HMO or a large block of flats, but actually if you have a relatively small one of these, they can be a very, very good solution. So I think in the round, given the fact swap rates haven't actually done a huge amount, maybe other than tick up ever so slightly compared to last week, not bad to see some lenders pricing downwards. Okay, the nuclear football that is pets in rental properties. So a company claims over 500,000 renters have had a request to keep a pet denied by their landlord, and this company has said that this was without a fair reason why, and I think that's the kind of key thing. So Go Compare Pet Insurance claims a survey it commissioned earlier this year suggests that 16% of renters have been denied the chance to keep a pet at home in the past due to landlord preference, and it claims this is equal to around 743,000 households. So more than 3/4, 79% of tenants who had a pet request rejected felt their landlord's decision was unreasonable, which it says equates to 590,000 households across the country. It adds that some of the most common reasons landlords deny a pet's request include concerns about damage to their property, a risk of nuisance or noise to neighbours, the property not being suitable for a certain pet, and increased insurance costs as well. So just to recap, under the forthcoming Renters' Rights Bill, which is very, very likely to pass into law in the next few weeks, landlords will be unable to unreasonably deny a tenant's request for pets. So what does this mean looking forward? So when asked if they would consider getting a pet once the rules have changed, just over 2/5 of 42% of renters who previously had a request denied or have not yet made a request for a pet said they would like to. So close to a quarter, 23% of these included renters who don't currently own any pets. So what it's looking like is that for those landlords who have said no to pets in the past, Renters' Rights Bills come in, and you may well find that your tenants are going to be coming back to you saying, we really want to get our cockapoo now, please can we? So what's interesting is I think realistically what you can do about this to protect yourself. So I know there's lots of landlords who are really kind of concerned about this. I think this generally stems from those people who've had a bad experience of pets in properties previously. I've actually always allowed my tenants to have pets in the property, and it's never been a problem for me. I guess I've been really lucky on that regard. But nonetheless, that I'm not sort of taking away from the fact that landlords are generally concerned about this. So I've done a bit of research for you to kind of see how you can protect yourself if you do find that post Renters' Rights Bill you're getting requests for pets in your rentals. So the bill allows landlords to require tenants to take out pet damage insurance as a condition of approval. And this is explicitly, I got my teeth in this morning, built into the proposed legislation. So you can require your tenants to take out pet damage insurance. That's kind of option one. Number two would be that you could use a pet agreement or a pet addendum. So this would sit kind of as a side note to your tenancy agreement. And what they say is that while you can't unreasonably say no to the pet in the property, you can and should document the agreement with clear terms. And these would include terms like only approved pets allowed. So an obvious one would be it's a 2-bedroom terrace house. You can't keep a horse in the garden would be a very extreme example of it. Or actually, this is an HMO. You can't keep pet tarantulas or snakes in the property because other people in the house might be uncomfortable. So those kinds of things. There can be other terms like no breeding, excessive noise or disturbance. Regular pest control or cleanliness checks will be essential, and the tenant is responsible for any additional wear and tear. And both you and the tenant would have to sign this, and this gives you something to kind of lean on if there were any breach of conditions, which meant that your property was damaged, your tenants were subject to, barking dogs or whatever it was. So that could be useful for you as well. Now, the research that I've done also strongly suggests doing inventory and midterm inspections. They say that actually one of the key things is you need evidence of how the property looks before the tenant moves in. So before, I guess, to demonstrate that the carpet wasn't chewed before the tenant moved in, something along those lines. And then you must do periodic checks after. So they say do a video or photo inventory before the pet approval. Midterm inspections, please note you have to do with notice. You can't just rock up when you feel like it. And then definitely an end of term inspection as well, with a pet specific checklist also. And they go on to say that actually by having this kind of very documented record, this will help with deposit disputes and insurance claims as well. Now, the other thing I've suggested you may want to consider doing is adjusting your landlord insurance. Now, most standard landlord insurances don't cover for pet damage at the moment. However, I do know that from speaking to Alan Boswell's, they are working really, really hard to get this included in some of the policies that they offer. So definitely worth checking back in with your insurer or having a look at the rest of the market. Speak to someone like Alan Boswell's, they're an insurance broker, they're really, really good. I know a lot of landlords love them and they will be able to kind of research what's available so you can protect yourself as well. So just to note, what you cannot do with pets is refuse all pets outright. So you have to consider it on a case-by-case basis. You cannot charge a pet deposit or a pet fee. These are banned under the Tenants' Fees Act. You cannot just ignore requests for pets. You must respond in writing within 42 days. And you cannot unreasonably refuse. So, for example, you can't simply say, I don't like cats. You can't have cats. You have to have a valid reason for the refusal. So, for example, allergies, unsuitable property types, or also danger as well. Moving on now to predictions for base rate going forwards. And interest rates, in an article that I read recently, in the UK could drop as low as 3% by the end of next year. And this is according to several economists. So you guys will recap that actually last week the Bank of England opted to keep base rate at 4%, citing persistent inflation, which is standing at 3.8% in August. And economists are now expressing differing opinions on the future path of interest rates, reflecting the difficulty in predicting when inflation will reach the bank's 2% target. So essentially, the reality is that inflation is incredibly persistent. We need to get it down to 2%. It's currently almost double that figure. So the MPC have got a very difficult job at hand to try and figure out how best they can leverage the tools that they have available to them to try and drive inflation down. So for the article that I read, 9 economists were interviewed. 4 anticipate that rates could fall to 3% by the end of 2026. Almost half of the panel, as it were, are saying by the end of next year, rates could be at 3%. This is base rate, not fixed rates. Please don't confuse the two. Others expect a more gradual reduction, with some forecasting only 1 or 2 further cuts. So some are saying that actually 3% is a little bit kind of ambitious. Reality is we're going to end up at more like 3.5 to 3.75%. So another thing that's quite interesting is the debate that's kind of ongoing over what's classed as the neutral interest rate. This is the level at which the MPC neither stimulates nor restrains price growth. So essentially things are just ticking over nicely. And this rate does vary between countries. The UK's current economic conditions may require a higher neutral rate than elsewhere. Market expectations are suggesting rates could settle at around 3.5%, although some analysts are believing the central bank may refrain from further cuts as well. So it could be that actually 3.5% kind of becomes our normal base rate. So looking ahead of the Bank of England's November meeting, economists are remaining divided. The MPC itself is split, with conflicting data on labour market and inflation complicating the outlook. They also provide a range of views on where rates will ultimately settle. So here you go. Here's a kind of load of economists and their views. So Anna Leach, chief economist at the IID, or Institute of Directors, expects rates to stabilise at between 3.5% and 3.75%. A chap from a company called the Pollux Exchange is expecting a fall to 3%, citing labour market weakness and fiscal pressures. A gentleman called Jack, who is the chief economist at Barclays, foresees a range of 3 to 3.5%, warning that delays in easing could require further action if economic growth slows. Jonathan Haskell, who works at Imperial College Business School, a former MPC member, agrees with the 3.5% estimate, suggesting that productivity gains from AI could keep rates slightly higher. Julian Jessup, an independent economist, bases his 3.5% rejection on inflation and growth metrics. And Callum Pickering, who works for Peel Hunt, expects a 3.75% rate due to ongoing inflationary pressures. So there you go, lots of people giving their 2 penneth worth, but it seems like actually in terms of base rate, I think what I read from that is basically 3.5%. It's going to be we should end up, according to those people that understand this stuff really well. So this is potentially good news for those of you who are on variable rates, because you will be seeing, if it all goes to plan, according to this report at least, a 0.5% reduction over the next year or so to your the rates that you're paying. What does this mean for fixed rates? Well, actually, the markets are seeing this data and pricing all of this in to their fixed rate pricing. Remember that fixed rates are a projection or a prediction of what's going to happen with base rate going forwards, not a look in the rearview mirror. So these guys are saying, well, over the next, if we're looking at a 5-year fixed rate, over the next 5 years, what do we think base rate is going to be? And they're kind of predicting that and putting that into their fixed rate pricing. So if fixed rates then if base rate behaves as expected, it doesn't really materially change the fixed rates, because these guys have essentially priced things right. If there's a big change to base rate, so for example, if suddenly, and just to be clear, this is never going to happen, well, not never, but unlikely to happen, base rate gets slashed to 0.5%, then that would be a notable change, and therefore that could then impact what happens with fixed rates going forward. So I think after all of this, in summary, we kind of are where we are in terms of fixed rates. Like I said in previous episodes, we're generally not expecting much change going forwards now, unless something kind of crazy happens. So I think realistically, for those of you who are kind of biding your time and waiting for the next base rate meeting to see what happens before you lock into a fixed rate, genuinely, as long as base rate behaves as people think it's going to behave, or the economists think it's going to behave, you really aren't going to see a huge amount of changing to fixed rates. Maybe they'll come down ever so slightly, but actually my bigger concern in the more immediate future is what's going to happen with fixed rates in response to the autumn statement. So if you are thinking about taking a mortgage out over the next few months, I really would encourage you to consider locking into a rate now. As I always say, you can always change it later if they come down, but do try and get yourself locked into a deal, book those rates and hedge your position. And that's us for this week. Thank you so much, as always, for having a watch, listen, a read, however you choose to receive this. If you have any questions, you can always give us a call, 0345 345 6788. Use our online chat, or you can send us an email, whatever works for you, basically. We are here to have this word with you and see how we can help. I look forward to catching up with you next week. Keep warm and have a fantastic week.